comments contained in this podcast do not constitute legal advice. The opinions herein are the opinions of the speakers and not the official opinion of the Hodgson Russ Law Firm. Hey there, tax fans. Welcome to State Tax Talks with me, your host, Joe Tantillo. I'm a tax attorney at the Hodgson Russ Law Firm looking to explore the nuances of state and local tax law. Here on the show, our goal is to keep tax informative, simple, and fun. So if you're ready to talk tax, turn up the volume and dive into this episode of State Tax Talks. Hey there, folks. Welcome to another episode of State Tax Talks with Joe Tantillo. Today, I am joined by SALT lawyers extraordinaire Andrew Wright and Tim Noonan, both longtime friends of the pod, previous guests. So welcome back, Drew. Welcome back, Tim.
Yeah, good. It's good to be here. Drew, is this your first time as SALT practice group leader?
It is.
Wow. Well,
yes.
Got anything? Any prizes for him, Joe? Or
I don't have any prizes, but hopefully it comes with additional 5-star reviews that we're bringing on people that have additional titles here.
Yeah. Congrats, Drew.
Congratulations to Drew, the new Hodgson Russ State and Local Tax Practice Group leader, the Piggle.
Thanks, guys.
Today we are going to be talking about tax issues faced by partnerships doing business in New York State and City, as well as related tax issues for the partners, particularly non-resident partners who have ownership in those partnerships. And it's an interesting issue because at least across my desk in the last 6 to 12 months, I've certainly seen an uptick in New York audit activity related to flow-through entities. Certainly partnerships have not been left behind in that regard. And in tackling those various cases, there is quite a bit of, I would say, misunderstanding out there kind of across the board on some of these partnership issues. So I figured it would be as good a time as any for us to sit down and have a conversation about, what are New York's rules when it comes to taxing partnerships and more specifically taxing the partners of those partnerships. So we're going to do, I won't call it a deep dive, but, we'll be out of the shallow water, at least on these issues today. And hopefully all you listening out there will appreciate this review of, basic partnership tax concepts.
Yep. And Joe, one of the reasons I think you're seeing that is because the state is sort of a deliberate effort to audit flow, these sort of flow through issues. So, for 30, 40 years, they've been auditing people who moved to Florida. We've already done that podcast 6 times probably,
Yep.
But, so that's obviously a huge issue, but certainly this is an offshoot of that where they're still auditing high net worth folks, but they're looking at partnership issues. They're looking at their K-1s. They're going behind just what's on the individual tax return and seeing what's going on at the partnership level. So that's why we're starting to see a lot of this stuff on our desk.
Yeah, and it's definitely not just New York either. I remember I attended a CLE last summer with some folks from the California Franchise Tax Board, and they openly talked about how taxation of flow-through entities was a priority for them in their audit group. So I think this is something that's going to be prevalent, not just in these super high tax states, but probably across the board for some of the reasons that you alluded to, Tim. So it's certainly a good time to start thinking about these concepts if they're not already in the forefront of your mind, especially for our tax practitioners out there listening. If this is something that maybe you don't deal with on a regular basis, or you do, and you want a refresher on the rules, this is going to be a good episode. And we'll start where you start with any basic, tax concept. We're going to talk about Nexus for partnerships, specifically New York's rules. What does it mean to have Nexus with New York so that they can tax your partnership, or again, tax the partners of that partnership, which we'll get to in a little bit. But Drew, why don't you highlight for us, what it means, what's New York's kind of core rule for Nexus for partnerships, and then we'll go from there.
So it's a doing business standard, Joe. The difficult part is that's a kind of a really unclear standard. What does that mean? All sorts of things that we know it definitely means, right? So having physical presence, the kind of things we would normally look at, right? Having an office, having employees, having inventory of goods, all of these things have historically created a physical presence and sort of qualify as doing business in New York for purposes of creating Nexus for the partnership. Otherwise, what it means to do business is kind of incredibly vague, I think, and not well defined. And I think part of the problem is a lot of the entities that historically did business as partnerships are entities that would have those kinds of physical presence, and it would kind of be super easy to know whether they were doing business in New York, kind of a know it when you see it kind of thing. Mm-hmm. But now we got all sorts of businesses that are, operating as partnerships that, operate globally and maybe don't have those kinds of physical presence, right? So it's, I think, a bit harder to measure.
Yeah, so let's talk about the rules in that context. And this is something that we've certainly all discussed before offline, but New York's rules for partnerships that don't have physical presence in terms of the specific Nexus rules are not as well defined as they are for, say, a C corporation. So, how should we proceed with respect to a partnership that otherwise has no physical presence in New York?
Yeah, again, I think it's kind of difficult to do. Often when I'm having the conversation, because all these economic nexus thresholds have come in the wake of the Wayfair case, which was probably another topic of a previous pod. And so we know what states have done from an economic nexus threshold perspective with respect to sales taxes post Wayfair. And so certainly if we wanted to be sort of super conservative, we could look at, there are states that have economic nexus thresholds as low as $100,000 in revenue from the state, right? So if we don't exceed that threshold, I think it's probably pretty clear that the partnership doesn't have economic nexus. Over and above that, I think it becomes a little bit difficult to quantify, right? Because from a sales tax standpoint, New York has actually veered the other direction, right? They haven't gone as aggressive as some states in their economic nexus tests. So New York has a $500,000 threshold for sales tax. And then, for corporate tax, for Article 9A purposes, there was a kind of bright line $1 million economic nexus threshold established back, with the corporate reform, Tim, right, in 2015?
Yep.
I think that's been increased a couple times. I think it's something like $1.28 million now. And so we've got all these kind of thresholds lurking about, none of which is kind of specifically for what it means for a partnership to do business in New York State.
We know that, what that rule is called, the Dr. Evil rule.
What's that?
The $1 million threshold.
I like that. I'm putting my pinky up to the corner of my mouth right now for those listening.
Yeah. $1 million.
What's interesting, though, is I listened to Drew talk about Nexus and partnerships. I'm thinking to myself, in 25 years, I can't recall ever fighting about Nexus in a partnership case. And I think it'll be clear in a couple minutes why. I didn't even really sort of realize why, but Nexus is often physical connection, having people, having payroll, having something like that. So if you don't have a lot of that or any of that, you're not going to owe any tax. We're going to talk about at least the apportionment rules for non-residents. Mm-hmm. So yeah, I haven't really, for residents pay tax on everything. So if they're, a partnership could be doing business in China, and if you're a partner in that partnership, you're going to pay tax in New York because you live in New York. But if you're a non-resident, you're only going to pay tax if the partnership has Nexus. But if it has basically nothing going on in New York, then they wouldn't even fight you about Nexus because the tax liability is going to be zero anyway.
Yeah, we talked about it at the summer tax series last year, and I thought it was interesting conceptually, but I'm kind of with you, and I haven't seen it come up, and I get why. You'd have to have such a specific set of facts where you were basically deriving receipts that were arguably New York source, but you would have to have no property and no payroll and 2 or more non-resident partners.
Yeah.
And you'd have to be under $500,000, I guess, even though, again, that's sales tax numbers. But to be like, we're under at least all of the written thresholds for other tax types, it would be a unique situation. And I don't know that the rules are entirely clear. I would argue in that case, let's say you had $400,000 of New York receipts and no other connection. I'd probably argue you don't have
right,
Nexus.
But as we're going to, I don't want to foreshadow the sourcing thing, but the sourcing rule isn't, I have New York receipts. The New York receipts will actually come if you have people in New York doing stuff from an office in New York.
Yes.
So if you don't have that, then you probably don't have any New York receipts anyway.
Yes.
Yeah, and for that reason, it's this is an academic discussion largely for New York State purposes, right? If we were sitting in a state with different rules than New York has, it might be a more kind of real-time question.
That explains
it's a podcast. We're supposed to be having academic discussions. So
exactly. It explains why Doyle was the first person who ever kind of posed the concept to me.
Yeah.
Very academic. All right. I think that is a good kind of segue into our next topic because we've already kind of teased it. So, Tim, I've alluded to this already, but in New York State, the partnership itself doesn't actually pay the tax. That burden falls onto the partners. So when we talk about partnership taxation issues, we're really talking about that taxation of resident and, more relevant to most listeners out there, non-resident partners.
Yeah, that's right. So, and that's consistent with federal tax law as well. Like partnerships are, I guess, what we call flow-through entities, right? So the income flows through to the owners, to the partners. Tax is not paid at the entity level. So there's one exception to that in New York City. New York City taxes partnerships. We'll talk about that later, I think. But for federal purposes, for state income tax purposes, partnerships don't pay tax. The partners do. So take the Hodgson Russ, law partnership. There's a bunch of partners. There's income that flows into the Hodgson Russ law partnership every year, and that the Hodgson Russ doesn't pay a dime in federal taxes. They don't pay state income taxes, but all the partners pay the state income taxes. Drew does, I do, Joe. Hopefully someday you will. But it's
cross, folks.
Exactly, yeah. So taxes paid by the individual partners. That does mean if you are a non-resident and you live in Texas and life is great in Texas, but you join a partnership and that partnership has activities in New York, you might not ever step foot in New York, not for one day, but that we'll talk about sourcing in a minute. But that would mean you could have a New York tax obligation because you're getting income from a New York partnership. So, but that's again because of the concept that the partners will pay the tax. So all the sort of issues that come up, the audits that come up, ultimately we're talking about an individual cutting a check for taxes, not the entity.
Yeah, hopefully this news is not shocking to anybody out there listening. You understand if you're a non-resident partner of a partnership doing business in New York, you have a New York filing obligation. You have to file a non-resident tax return and pay tax on, the portion that's flowing from New York. Should be getting a K-1. If that's not happening, call one of us. But it creates interesting issues, I think, around the sourcing rules and the three-factor rules that we're going to talk about in a minute here. And certainly even outside of the context of the partnerships themselves getting audited, in our planning context, we assist people all the time with moving not only themselves out of the state, but having conversations about, okay, well, you are a partner in a partnership. Is there anything that you can do to reduce your New York business allocation percentage to reduce the tax that you're going to keep paying to New York as a non-resident? So there's a lot of ways that it kind of manifests. For New York resident partners, I would be remiss if I didn't bring up the PTET, at least briefly. So PTET is, the one situation, at least at the state level, where the entity is going to pay the tax on behalf of the partners. But it's really just a workaround, isn't it, Tim?
Yes. So it's a pretty cool thing that New York State has developed, and it's a scheme that New York and many other states have developed to get around the cap on the deduction for state and local taxes that was put in place in 2018, affectionately known as the SALT cap. So what the SALT cap did to all of us suckers who live in New York State and other high tax states, it used to be that if I paid $100 in New York taxes, that stunk, but I would get a deduction off of my federal taxes for $30 or something like that. So every $100 of New York State tax I paid, it really only cost me like $65 or $70 because I could deduct those taxes off my federal taxable income. So that was good. So it was a nice sort of side benefit to folks living in high tax states. So in 2018, Tax Cuts and Jobs Act said, well, we're going to probably a shot across the bow by President Trump at the blue states, but who all actually have high taxes, most of them. So we're going to cap that state and local tax deduction to $10,000. So that stinks. So for people who live in high tax states, now when I pay $100, I'm paying $100. I'm not, and that's income tax, that's property tax, right? So that's all. You used to be able to deduct all of it. Now you could only deduct $10,000. So it was a big deal, especially to a lot of our clients who, all of a sudden were like, wait, I mean, I was okay paying those taxes because at least I was getting a deduction. That was good for business for us because it caused a lot of people to say, all right, I'm getting the hell out of here now. Enough already. I'm moving. And then COVID 2 years later, and then New York raising their rates a year later. I mean, oh my God, we've been busy. But this thing is out there and it's really bad. So the governments in a lot of these states that have high taxes thought we got to do something about this. And they came up with sort of a genius idea, which is to basically, because companies can still deduct their taxes. So they said, well, what if we do this? What if for partners and partnerships, instead of having just like we went through, partners pay the tax, they cut the check. What if we say, actually, we're going to have the entity pay the tax, sort of on behalf of their partners, so that you get the deduction for it for federal purposes. The partnership can deduct the state tax that the partnership pays for federal tax purposes. The $100 now in New York tax I would pay, I don't pay that anymore. My partnership pays the $100 in tax. Now, it's not a windfall for me because the partnership paid $100 in tax. My income is down $100, right? So, I mean, I'm not getting a windfall there, but that's actually a good thing. My income is down $100. That means I pay tax on $100 less. So now I get the benefit of the state tax paid. And then when I go to file my New York taxes, I get a credit for the tax I would have otherwise had to pay because my firm basically paid the tax for me. So that's the idea behind these PTET regimes. And again, now like most states that have an income tax have these regimes in place. And it's been a super effective way for states to combat the loss of the SALT deduction. It's really a sort of creature of flow-through taxation. So S corporations can do it, partnerships can do it. But if you're a high wage earner, sorry, too bad, so sad. No PTET for you. But otherwise, it's a great program that's been in place. It's super complicated. The poor accountants having to deal with this every day. Oh my God, it's the worst.
Yeah, we did. For those accountants out there listening, thinking, yeah, it's a pain in the butt, we did do a deep dive with Liz Pascal and Chris Doyle from our offices.
Oh, you did?
On
Okay.
this topic. Yeah,
right.
I think it was like 2 or 3 episodes on it. Really, it actually did get into the weeds on PTET. Our editor is nodding. He remembers.
Had to be more boring than this one's going to be.
I was going to say I should listen to that, and then I had to.
No, I'm not listening to that. Yeah.
But so if anybody wants a deeper dive, I think the way that Tim just summarized it was excellent and gives you the need to know information. But if you want a really deep dive on more of the mechanics and the rules for actually making the election, who can make it and how the portal works and all the deadlines, et cetera, go listen to those episodes.
There's a podcast for that.
There's a podcast for that.
Nice.
I also wanted to mention briefly the UBT, which we'll come back to and talk about more fully later on in the episode. But the UBT is a New York City imposed tax that is an entity level tax on partnerships doing business within New York City and the 5 boroughs. We'll come back and talk about that more later unless you want to hit it at a high level now. But I think that we'll save that surprise for the end.
Sounds good.
Okay, guys, we're going to pause our discussion here. I've been talking about partnership taxation, or more specifically, the taxation of non-resident partners and New York's rules for that with my colleagues Tim Noonan and Drew Wright. There's a lot more to discuss, but we're going to take a pause for now and pick up this conversation in the next episode, which will be part 2. Until that time, this is State Tax Talks. I'm Joe Tantillo. We'll see you real soon. Thanks for joining us for another episode of State Tax Talks. If you're interested in listening to more episodes, we're available on all platforms where podcasts can be found, including YouTube. If you enjoyed this episode of State Tax Talks with Joe Tantillo, please give us a 5-star review on your favorite podcast platform. And if you're in need of a tax professional, you can contact the tax attorneys at Hodgson Russ. Go to www.hodgsonruss.com for more information. And until next time, I'm Joe Tantillo, and this is State Tax Talks. Catch you later, tax fans. The comments contained in this podcast do not constitute legal advice. The opinions herein are the opinions of the speakers and not the official opinion of the Hodgson Russ Law Firm.